Happy Friday, everyone. Thanks for joining us on Business Daily. I'm Lee-Jiun in Seoul. Let's get started with a glimpse of today's highlights. Over 300,000 non-regular workers in the public sector will be eligible to switch to more stable, regular positions, thanks to the government's push to provide more job security. From major central bank meetings to U.S. President Donald Trump's stance on trade ever since he took office, we take a look at what business stories made headlines around the world this week. Lawmakers are renewing efforts to reach an agreement over the government's roughly $10 billion supplementary budget bill to finally bring an end to weeks of intense political wrangling. Coming just one day after the National Assembly made some progress by passing the government reorganization bill, the Parliamentary Budget Committee is meeting again on Friday, where rival party lawmakers are trying to fine-tune the details of the proposal. Now, at the center of the debate is a large chunk worth some $7 billion aimed at creating 12,000 new public sector jobs, which the main opposition Liberty Korea Party continues to strongly oppose. The goal is to have the bill reviewed as soon as possible so they can table it for full floor vote, hopefully later today. The Moon Jae-in administration's first finance strategy meeting is now in its second and final day. On day one, President Moon and his team of budget officials, cabinet members, and members of the ruling Democratic Party discussed ways to finance the administration's key policies. These included job creation, addressing low birth rates, and promoting fair competition, while today's session will focus on ways to nurture growth engines for the economy. These include building innovative R&D platforms for future economic growth, supporting urban renewal projects, and improving social services. The finance strategy meeting is held once a year to present a roadmap for the nation's overall budget and spending policies. More than 300,000 non-regular workers in the public sector will be able to feel more secure in their jobs as they will be upgraded to regular positions starting this year. Now, the move is based on President Moon Jae-in's election pledge to create better working conditions for irregular workers. Our Shin Se-min has this report.
The initiative calls for changing the employment status of temporary workers to more stable regular positions. The government announced that some 310,000 non-regular workers serving in the public sector will be eligible. The number breaks down to 190,000 fixed-term workers and 120,000 temporary agency workers that include janitors, cleaners, and security guards. The Ministry of Employment and Labor says that those expected to be on duty for over 2 years or 9 months in a year will be eligible to sign a full-time contract that comes with employment benefits and more job security.
The initiative will be carried out based on consultations between labor and management. Those eligible will either be directly employed or hired via a subsidiary, depending on the job description.
The move is in line with the Moon administration's policy goal of creating quality jobs. Not eligible for the shift in employment status are replacement holiday workers and positions offered as part of unemployment and welfare programs. Also, workers over the age of 60 are excluded, though they may be allowed to extend their retirement age to 65. The ministry plans to expand the initiative to state-affiliated agencies starting next year. Shin Se-min, Business Daily.
Earlier today, Prime Minister Lee Na-kyun promised to make it easier for small and medium-sized companies to do business, emphasizing the need for shared growth. Let's hear what he had to say at the SME Day in Seoul.
The government will provide support to firms that show good prospects. We will foster an industrial ecosystem where mid-sized companies can grow well.
Prime Minister Lee also thanked small and medium-sized firms for their contributions to the Korean economy under tough business conditions. He added the government will make headway in promoting fair market competition by preventing large business groups from abusing their dominant status in the market. With Korea's minimum wage set to increase 16.4% next year, there are concerns that employers will lay off part-time workers to save on wages. Now, this in turn may weaken the job market, running counter to the government's aim of strengthening it. Our Lee Ju-young has more.
When Korea's minimum wage rises to $6.70 next year, 8 out of 10 employers said they will reduce part-time employment. This is according to a survey of 6,000 part-time employees and employers by job portal 알바천국. In regards to how they plan to manage staffing when the wage hike kicks into effect, 80% of the respondents said they plan on either reducing part-time employment, operate it themselves, or enlist their family members to run the business. Part-time jobs are being threatened by more than just the minimum wage increase. Businesses that are suited to automation, like restaurants and cafes, are relying more on newer equipment that replaces manpower. Many gas stations are converting from full to self-service, but some of the most rapid transitions are occurring at fast food restaurants. A quick peek inside many of them shows the automated ordering kiosks being prominently displayed. With many locations now taking orders solely through these kiosks, this eliminates work that part-time employees were normally responsible for. The paradox of a simultaneous increase in both minimum wage and financial vulnerabilities through layoffs looks like it will remain. Other plans will likely be required to curb the more immediate negative effects until the longer-term positive effects can make their mark. Lee Ju-young, Business Daily.
Local stocks extended its rally underpinned by strong foreign buying. To give us a wrap-up of today's session and this week's stock market action, we're now joined by our markets contributor Lee Ji-hye on the phone. Hello, Ji-hye.
Hello.
All right, so how did things look on the last day of trading?
Yes, Korean shares closed at another record high for the 7th straight session. The benchmark Kospi rose 0.34% to close at 2,450.06 points, while the tech-heavy Kosdaq also gained 0.01% to finish at 676.6 points. The main bourse started the session in the red, but rebounded into positive territory, where it remained until the closing bell. Trading was highlighted by strong net foreign buying, with institutional investors picking up shares as well. Tech and auto shares underperformed the wider market, however, with Samsung Electronics falling 0.23% and Hyundai Motors shedding 0.34%. Among gainers, the state-run utility firm KEPCO rose 2.82%, while the mobile carrier SK Telecom climbed 2.85%.
And Asian equity markets were down across the board today, especially after the European Central Bank announced no changes to its stimulus policies.
Yes, that's right. Hong Kong's Hang Seng Index was trading down on profit-taking after the market opened on quite an upbeat note today. Hong Kong shares have been on a 9-day winning streak so far. In China, the markets were little changed, with both the Shanghai Composite Index and the Shenzhen Composite Index trading mostly flat throughout the day. Meanwhile, in Japan, the Nikkei fell 0.22%. The Bank of Japan kept its benchmark rates steady on Thursday in its July policy meeting, while suggesting that a near-term change in its monetary policy was unlikely. The BOJ statement was expected to offer hints on its annual bond purchases worth 80 trillion yen, with recent signs pointing to a possible tapering.
Now, you mentioned that Hong Kong shares, although trading down today, is at levels near a 2-year high.
Sure, yes. As of yesterday, Hong Kong stocks finished higher for a 9th straight session on Thursday, which is its longest winning streak since April 2015, and powered by a rally in tech shares. Speaker manufacturer AAC Technologies, which supplies Apple, touched an all-time high, which was in line with tech stocks in the U.S., breaking dot-com era records on Wednesday. Chinese gaming and social media firm Tencent Holdings also set a new record, having risen more than 10% since July 7th, when it made its announcement to launch its mega-hit smartphone game in Europe and the United States this year. Analysts remained optimistic, saying that the modest pullback in the Hang Seng today is simply the market catching its breath after its longest winning spell in more than 4 years. This has been Lee Ji-hye for Business Daily.
Exports have grown immensely in the first 20 days of July. According to the Korea Customs Service, total exports in the first 20 days of this month was tallied at roughly $30 billion. This is a 22.4% surge compared to the same period last year. If the current pace is maintained until the end of July, exports will have grown for the 9th consecutive month, the longest streak since December 2011. Exports in shipbuilding led the gains, jumping nearly 246%, followed by semiconductors, while auto parts and wireless communication equipment both fell. By country, outbound shipments to Vietnam grew nearly 22%, followed by the EU at around 13%. Imported U.S. beef will face tougher inspections from the Korean government after a case of mad cow disease was detected in the U.S. state of Alabama earlier this week. Our Cha Sang-mi reports.
Boxes of American beef are unloaded for inspection. State inspectors check the shelf life and export labels and use infrared thermometers to ensure that the beef hasn't gone bad. The Korean government expanded the sampling and inspection of imported American beef from the current 3% to 30% of all inbound shipments. The Ministry of Agriculture, Food and Rural Affairs held an Animal Disease Control Council on Wednesday to share information on the outbreak with producers and consumer groups and discuss health and safety measures. The government also emphasized the latest case of mad cow disease is very unlikely to spread as this case is rare and spontaneous. Bovine spongiform encephalopathy, or mad cow disease, typically spreads through cattle eating contaminated animal feed, but the U.S. Department of Agriculture said that in this case, the cow tested positive for atypical BSE, which can occur spontaneously in older cattle. Another reason to feel relieved is that no meat from the area of the outbreak is exported to Korea.
There are no slaughterhouses or meat processors based in Alabama, where the mad cow disease was detected this time, that are approved to export to our country.
Also, all imported American beef is under 30 months old, so any specific threats are eliminated during the slaughtering process. The U.S. Department of Agriculture are carrying out more tests on cows in the region, and the Korean government may take further measures based on the results of these tests. Cha Sang-mi, Business Daily.
Mercedes-Benz Korea has announced a recall of around 110,000 vehicles sold here in the country, following a similar move over in Europe. The German automaker said earlier this week that it was voluntarily recalling more than 3 million diesel cars in Europe over concerns of toxic emissions. The carmaker is expected to spend more than $250 million to repair and upgrade the vehicles at no cost to the owners in order to reduce emissions. This is a big blow to the company and the market for diesel cars in the wake of Volkswagen's emissions cheating scandal back in 2015. Online sales now account for 19% of all domestic transactions, boosted by smartphone shopping. According to a report by Statistics Korea, retail sales in the first quarter surpassed $86 billion, up 4.7% from last year. Online transactions accounted for 19.6% of the total sales, to over $16 billion during the same period. This is in stark contrast to 2010, when online sales only took up 8.2% of retail sales. Although sales in the retail sector grew only 4.7% in the first quarter, the online portion of the total grew in double digits. An official from Statistics Korea noted that online shopping has grown and improved as smartphones have become more ubiquitous. The Korean semiconductor industry is going from strength to strength. With the construction of new production facilities, mergers and acquisitions, and R&D efforts, there's still a lot to look forward to. Here's our Elliot Kim with more.
Q2 sales estimates for Samsung Electronics' semiconductor business came in at over $15 billion. Intel has held the top spot for 24 years, but Samsung is expected to overtake the Silicon Valley giant in quarter two. In fact, with the steady growth in semiconductor demand, Samsung Electronics has built the world's largest semiconductor factory in Pyeongtaek, just outside of Seoul. The company plans to invest another $33 billion in its production lines in Korea and China by 2021. Samsung Electronics also has plans to invest more in its relatively weak system semiconductors business, creating a separate foundry unit to focus on the production of system semiconductors, setting its sights on Taiwan's TSMC, which holds the largest market share in the sector. SK hynix is also making aggressive inroads into the semiconductor industry as it hopes for a successful bid to purchase Toshiba's memory unit. The purchase would bump SK hynix from 5th place in NAND chip market share to 2nd place, right at Samsung Electronics' heels. And like Samsung Electronics, SK hynix has also established a separate unit for system semiconductor production.
It's important to diversify the business structure from being too reliant on memory semiconductors. We need foundry and non-memory semiconductor businesses that can prosper in the future, along with a localization of the supply chain.
With semiconductor demand diversifying across new industries like artificial intelligence, new competition, especially from China, will continue to emerge. Korean companies will need to expand their scope to compete in an ever-changing landscape. Elliot Kim, Business Daily.
Time now for a look at some of the global business stories that made headlines this week with our Eunice Kim, who joins us in the studio today. Hello, Eunice.
Happy Friday.
All right, so let's start with some updates on central banks. The ECB and the BOJ held their monthly rate meetings this week with no big changes on their monetary policies.
You're absolutely right. Both the ECB and the Bank of Japan keeping their key rates for the ECB at 0% and the BOJ at minus 0.1%. But there were some hints as to what could be on the horizon in the months to come. Let's go ahead and start with the ECB, the latter of the two meetings on Thursday local times. The European Central Bank's Mario Draghi, while expressing, quote, unquestionable improvement in Eurozone growth, said policymakers were exercising patience to avoid harming the bloc's recovery.
After a long time, we are finally experiencing a robust recovery where we only have to wait for wages and prices to follow course to our objective, to move towards our objective. Now, the last thing that the Governing Council may want is actually an unwanted tightening of the financing conditions that either slows down this process or may even jeopardize it.
Draghi also said discussions of tapering would be on the table sometime in the fall months, a move that investors took as confirming their expectations for monetary tightening sometime next year. In the currency market, the euro rose against the U.S. dollar to hover close to two-year highs on that news. Meanwhile, no signs of tightening out of the Bank of Japan. BOJ Governor Haruhiko Kuroda postponed the central bank's deadline to achieve its 2% inflation target by 1 year to March 2020, which would be 5 years after Kuroda's initial call. The Bank of Japan said it expects core consumer prices, excluding volatile food prices, to reach an average of 1.1% in the current fiscal year through March of 2018, revised down from an earlier forecast. Economists surveyed by the think tank, the Japan Center for Economic Research, though, were less bullish, calling it to fall short of 1%.
All right, let's now turn to the United States. Now, Thursday marked exactly 6 months since President Donald Trump was sworn into office. Now, he has done a lot in that time, but for better or for worse?
Right, a lot of people asking that question. History will likely be the judge of that in the end. One of the policies he's been consistent, though, on so far is his promise to put America first. What has that meant for trade so far? Take a look.
U.S. President Donald Trump kicked off the week with a special trade show of sorts organized by the White House that put the spotlight on American manufacturing. Climbing onto a fire truck in a Stetson cowboy hat, Mr. Trump promised more action to protect struggling American manufacturers.
I want to make a pledge to each and every one of you. No longer are we going to allow other countries to break the rules, steal our jobs, and drain our wealth, and it has been drained.
Already at play, steps to make good on, quote, leveling the playing field, at least in optics. Labeling existing trade deals as unfair, President Trump has pulled the world's top economy out of TPP negotiations, the Paris Climate Accord, and is pursuing revisions to the chorus FTA as well as NAFTA, its trade pact with neighbors Canada and Mexico. The administration's high-level economic talks with its #1 rival, China, this week ended inconclusively, yielding little tangible results at the end of its self-imposed deadline of 100 days since President Trump and Beijing's President Xi Jinping had their highly publicized face-to-face meeting.
The fundamental asymmetry in our trade relationship and unequal market access must be addressed. We must create more balance in our trade by increasing exports of made-in-America goods to China.
Meanwhile, back at home on the promise of deregulation, new data out of the White House Budget Office shows nearly 470 planned regulations were blocked in Mr. Trump's first 5 months, including 19 with an economic impact of $100 million or more. Another 391 were placed on hold for further evaluation. That's a tune investors can get behind. The tech-heavy NASDAQ has hit 3 record highs over its notable 10-day winning streak so far. As analysts note, risks on the fiscal and political fronts look not to be a market factor amid the heated rally. Nonetheless, the risks are there. The Republican Party was dealt a major blow this week in again failing to garner enough votes among its own lawmakers to pass a health care reform bill to replace Obamacare. This, as reports today say special counsel Robert Mueller, tasked with investigating possible Russia ties to the 2016 presidential race, is widening his inquiry to include the president's business dealings, drawing closer to Mr. Trump and his inner circle.
Well, all important factors as we head into the next 6 months of the Trump administrations. Now, is there any indications as to what derailed the press conference that was set to take place after that Beijing-Washington economic talks this week?
Well, no explicit comment on that so far from either the U.S. or China's side. The Wall Street Journal, though, citing persons familiar with the talks, reporting a major sticking point during Wednesday's talks was the U.S. demand to draw up a concrete plan, timetable and all, to achieve what Washington believes is a fairer trade. Now, ahead of the talks, Commerce Secretary Wilbur Ross had noted that China accounts for nearly half of U.S. trade deficits in goods. This as China's Vice Premier Wang Yang urged continued dialogue and not confrontation, adding there were over 60 rounds of working consultations in the run-up to this meeting. Meanwhile, the U.S. will head to the negotiating table with Canada and Mexico in a few weeks' time on August 16th to begin restructuring NAFTA. And perusing through a list of goals published by the Trump administration this week, trade experts said the U.S. leader's trade vision there could be a boon for American e-commerce sites such as Amazon and eBay. Now, this is because he has his eyes on raising the duty-free spending threshold for Canadian and Mexican consumers from $16 and $50 respectively to $800.
Well, we'll definitely look forward to how that all plays out. Thank you so much for coming in today.
You bet.
And that wraps it up for today and this week. Thanks so much for watching. I'll be back next week with more at the same time, same place for your Business Daily. Until then, goodbye.